Hello everyone. My name is Xuelian Piao from Gwangwon University, Korea. It's my honor to have a presentation in FoCos conference. The topic of my presentation is organization's resource and fluctuation. I'm going to split my presentation into 4 parts. In introduction part, I will explain research background, research question, research gap, and the research context and framework and contribution of our study. Then I will explain the hypothesis development. And in the third part, I will explain data and methodology, as our paper is an empirical paper. And continuously, I will show the findings and results of our empirical tests. And in the end, I will make a conclusion. So, research background of our paper is as following. Resource-based view is a famous theory in management field. So, resource-based view indicates that a firm can generate the sustained competitive advantage if the resource have the characteristics of valuable, rare, and immutable, and non-substitutable. So, there are many studies have suggested that there are 2 key resources, R&D and advertising, satisfy the characteristics of the resources which create a sustained competitive advantage. But many firms are tempted to reduce the investment of R&D and advertising, especially when facing the fluctuated environment in the perspective of short-term liquidity. So our research question is that, is it right to slash the budget of R&D and advertising frequently according to the business environment? And what is the role of R&D and advertising resource in a firm's entire life? So there are some questions that how is the effect of R&D and advertising resource on firm value, and how do these resources interact? So this slide is about the research gap. We found these research gap after doing some literature review. And we found that some scholars mentioned that little empirical research has addressed the question of how different environmental conditions affect the relationship between resource and firm performance. And especially, there are lack of study have adopted the non-perceptual performance measurement, such as firm value. So we will adopt this objective performance measurement in this study. And also, when we focus on the R&D and advertising, there is still lack of study to investigate whether the effects of R&D and advertising on firm performance vary with the conditions of the surrounding environment. So in this study, we will adopt the measurement of environmental fluctuation. And also we found that there are some research questions to solve, such as do the do these types of resources, such as R&D and advertising, substitute for or complement one another? So, if there are some relationship in these two types of resources, is it applicable under the fluctuated environment? So, yeah, let us look at the research context and framework of our study. We make use of research context of South Korea. Since South Korea has a market economy which ranks 12th in the world by nominal GDP in 2019, so identified as one of the G20 major economy. And South Korea is a strong export-oriented economy. Today, Korea depends on exports of 50% of GDP, the highest ratio among G20 countries. So due to this export-oriented and open economic structure, South Korea undergoes a lot of economic fluctuation with the effects from the global economy. So South Korea has already suffered from two financial crises, including 1997 Asian financial crisis and 2008 global financial crisis. We build our research framework as following. Firstly, we will confirm whether there is positive relationship between R&D advertising and firm performance. And we will focus on firm value because firm value is performance measurement indicating the near future performance. And then we will examine whether the above relationship keeps stable under the fluctuated environment, and also we will examine whether R&D and advertising resources complement each other when explaining firm performance. And also we will look at that whether the above relationship have some change under the fluctuated environment. So I want to highlight the uniqueness and merit of our study. We think our study can have the following theoretical contribution. Firstly, this study contributes to the study of resource-based view, adding the factor of environment fluctuation. Because our study can provide another evidence for resource transition to dynamic capability. Dynamic capability is the capability that help the firm to upgrade existing or create new capability. And because our study use non-perceptual performance measurement, it is a more objective performance measurement. So this is a contribution to the study of resource-based view. Secondly, our study investigates the role of R&D and advertising resources So we will clarify the effects of these two resources on the firm performance, and also we will examine whether the environmental fluctuation affect the relationship between these two resources and the firm performance. And thirdly, our study will clarify whether it is a substitutive or complementary relationship between R&D and advertising resources. As you know, the R&D and advertising activity represent different parts in the firm's value chain, but these two resources have some special relationship. So we will investigate the specific relationship between these two resources. And if so, this study can guide firms' investment in these two types of resources. So it will be an important managerial implication. Next, let's look at the hypothesis development. It is about the effects of R&D and advertising resource on firm performance. So investment in R&D generates new technologies or products and improves the existing technologies or products. If so, it can improve firm performance. So there are already studies that have proved the positive relationship between R&D and firm performance, such as China et al.'s 2001 study. They found that R&D investment can increase stock return, and also Lev et al.'s 1996 study, they found that R&D increase market value, and also Kotabe's study found that R&D can improve profitability. In addition, investment in advertising attracts more customers to the firm and bears the brand recognition so as to increase sales and charge premium prices. Studies that have proved the positive relationship between advertising and firm performance is Riley et al.'s 1977 study. They found that advertising investment can increase stock return. So therefore, we propose the following hypothesis. Each one is the R&D intensity is positively related to the firm value. And the second hypothesis is that the advertising intensity is positively related to the firm value. So the second hypothesis is regarding complementarity of R&D and advertising. If firms develop more innovative and wonderful products with more R&D investment, these products can increase firm performance. Simultaneously, advertising investment also promotes the awareness of product innovation and superiority, and complement the effect of R&D on firm performance. If firms build reputation and strengthen the target customers through advertising investment, this also improves firm performance, right? Simultaneously, R&D activities also improve the brand effect through product upgrade and development. So it can complement the effects of advertising on firm performance. So R&D research and advertising research can complement each other to improve firm performance. So we propose the second hypothesis is as following. The interaction of R&D and advertising intensity is positively related to the firm value. Yeah, the last hypothesis is regarding economic fluctuations. Yeah, some scholars argue that consumers or customers can delay or reduce the purchase facing economic recession. Accordingly, firms cannot achieve the expected sales or profits even they have already invested the considerable R&D and advertising expenditures. But in our study, we assert that when firms have strong capability, based on sufficient R&D and advertising resource, despite the economic fluctuation, firms can catch the consumer's needs and satisfy the consumer through superior products and services. Therefore, firms can achieve considerable market share and improve firm performance when other firms cannot achieve good performance. So the last hypothesis is three small hypotheses. The first one is the economic volatility will not lessen the effect of R&D intensity on the firm value. The second, the economic volatility will not lessen the effect of advertising intensity on the firm value. The last one is the economic volatility will not lessen the interaction effect of R&D and advertising intensity on the firm value. In third part, we will look at the data and methodology. As I have already explained, we adopted the research context of South Korea. And the firm level data, we gathered the data from case value database of Korean company, and from this database we obtained 447 KOSPI publicly listed manufacturing firms for long term from 1993 to 2012. So it consisted of 8,032 firm year observation, and economic fluctuation. We used the measure of exchange rate volatility, as there are other studies also used this measure. And dependent variable firm value. We use the Tobin Q. Tobin Q is very familiar measurement to represent firm value. And independent variable, there are three variables. Firstly, R&D intensity, identified as the ratio of R&D expenditure to total net sales of a firm. It is similar to advertising intensity measurement. And the economic fluctuation measurement is proxied by the standard deviation of daily exchange rates in a certain year. So this figure is the trend of exchange rate volatility, representing economic fluctuation or volatility trend of Korea from 1993 to 2012. So exchange Yeah, volatility is especially high in 1997 and 2008. Yeah, exactly correspond to the two financial crises. So in control variables uh, include firm size and firm age. Firm size is measured with two variables. One is the logarithm of firm asset. The other one is logarithm of the number of employees. Firm age is firm's duration years since the firm established to the time of observation. And we used several tests in data program and make a conclusion to employ fixed effect regression model for our data sample. Equation 1, 2, 3 present the regression models used in this paper. So equation 1 mainly show the effects of R&D intensity and the advertising intensity on the Tobin's Q. Equation 2 tests the effect of the interaction term between R&D intensity and advertising intensity on the Tobin's Q, controlling the independent effects of R&D intensity, advertising intensity. Equation 3 will add the integrating effect of economic volatility with the R&D intensity and advertising intensity and the interaction of R&D and advertising intensity. So the three equations all control the economic volatility, the firm asset, the number of employees, and firm age, etc. So let's look at the results and findings of our empirical tests. And first table is about descriptive statistics of the variables in our sample. So there are the mean value, standard deviation, such a max value, etc. The second table shows the correlation coefficient among the variables. And when we check the multicollinearity problem with the command of VIF, all the values are much less than 10, so it can be concluded that there is no serious multicollinearity problem. And this table is the most important table. So this table shows the results of fixed effect regression of three equations. If you see the overall R square increase little by little from equation 1 to equation 3 as the explanatory variables are added into the regression equations step by step. It means the fitted variables are being added, which are increasing the explanatory power. Also, we have to recognize that R square is not increasing much in the long panel data. First, we will look at the R&D intensity. The results of all the three equations show that R&D intensity is positively related to the firm value, controlling other variables. This suggests that R&D resource is so important that it could create a competitive advantage for the firms. Yeah, results support the hypothesis 1A. Second, we check the advertising intensity. Yeah, only in equation 1 there is significant result at 10% level. However, though the sign of the coefficient is positive, the magnitude is small. Some studies have already proved that the advertising effect is relatively small in the manufacturing firm rather than the non-manufacturing firms. So the small size of coefficient of advertising intensity could find a cause in our sample, which only include the manufacturing corporations. So this result can support the hypothesis 1B in a certain degree. And there are coefficient of the interaction term of R&D intensity and advertising intensity in equation 2 and 3. It is positive and significant at 5% level. It is worthy of notice that the magnitude of the coefficient is very big. So it could be inferred that the synergy of R&D resource and the advertising resource is very big. So firms have to balance these two resources in the management of manufacturing firms. So it clearly supports the hypothesis too. And let's look at the third group of hypothesis tests. So it is about impacts of economic volatility or fluctuation on the effects of R&D, advertising, and one interaction term. So if we look at it, the coefficient, only the coefficient of R&D intensity and volatility is significant, but the coefficient is very small. So the negative and significant sign shows the volatility lessens the effect of R&D intensity, but because the size or magnitude of the coefficient is very small, it nearly loses the economic significance. So economic volatility almost does not impact the effects of R&D intensity. So it does not reverse the effects of R&D intensity on firm value. Also, in addition, the coefficient of advertising and the interaction term is not significant. So the three coefficients indicates that economic volatility almost does not reverse the effects of R&D intensity, advertising intensity, and the interaction of the two intensity on firm value. So these findings support the hypothesis 3A, 3B, and 3C. So conclusion, the findings of this study is as following. R&D and advertising resource creates sustainable competitive advantage, even under the fluctuated environment. And the second one is good combination of R&D and advertising resource amplifies each independent effect on the firm value. And the economic fluctuation does not reverse the effect of R&D or advertising each and the combination of the two resources. So our study can replenish the resource-based view, focusing on R&D and advertising resource in the context of South Korea. And since we run the fixed effect regression model, the empirical test incorporated unobserved heterogeneity and serial correlation for rigorous empirical tests. So in the end, we will emphasize the managerial implication of our study because contribution of our study have been introduced in the beginning part, so we will not repeat it again. This study tells us that firm value is impacted by the firm's key resources such as R&D and advertising. So it indicates that investment in R&D and advertising is very important, even under the fluctuated environment. So when firms face high volatility and fluctuations in the business, they shouldn't reduce the expenditures, especially in R&D and advertising activities, because they can create the sustainable competitive advantage and assure the long-term survival, even under the fluctuated environment. And the most important is the synergy of R&D and advertising. The two resources should be jointly incorporated into decision making. So firms shouldn't do biased investment in R&D or advertising each. So keep balance of R&D and advertising is very important. And limitations and further research, we suggest future research can adopt the context of other countries and may supplement data for longer term and can include some include the non-manufacturing firms in the data sample. And future research can compare the other performance measurements, including perceptive performance, etc. So this is the end of my presentation. Thank you for your attention.